Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Fiserv.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into the numbers, we should quickly mention StockOracle.
Right, yeah. StockOracle is an AI-aided stock research platform that we use to look at some of these data points.
And you can find a special 14-day trial link below in the description.
Just a quick heads up, that is an affiliate link, so the channel may earn a commission at no extra cost to you.
But we always like to remind you, StockOracle's AI insights and valuation estimates, they can be incomplete or wrong.
Exactly. You always have to verify important facts for yourself. It is definitely not financial advice, it's not a trading signal service, and it's not real-time market data.
Right, just a tool to help you dig deeper.
Okay, so let's get into this because today's talk is, well, it's basically a financial mystery.
It really is.
Imagine you're, walking past a harbor, right? And you see this massive, once majestic cargo ship.
Like a total behemoth.
Yeah, exactly. But the paint is peeling, there's water actively sloshing over the lower decks, and everyone on the dock is just screaming that the ship is going down.
Total panic. Institutional money managers are sprinting away.
Sprinting away, yeah. But then you look a little closer, and you notice something completely bizarre.
Which is always where the good stuff is.
Right. The captain, the senior officers, and some of the most ruthless, calculated shipping magnates in the world are quietly walking up the gangplank onto that sinking ship.
And they are carrying heavy briefcases full of their own cash.
That is the exact setup we are looking at today with Fiserv.
It's the ultimate market contradiction, honestly, because in wealth building, trying to distinguish between, catching a falling knife where your capital just goes to die,
right,
and identifying a generational value play, it often requires you to completely ignore the panic on the dock.
You sort of have to put on a hazmat suit and climb down into the engine room?
Exactly. You have to figure out if the machinery is actually broken or if the market is just, mispricing the water on the deck.
Okay, so if you are putting your analytical hat on with us today, you have to reconcile this massive divergence in market psychology.
Because Fiserv is a titan in the financial technology space.
A giant.
Right.
But if you look at their stock chart over the past year, it resembles a slow-motion disaster.
It's undeniably ugly.
We are looking at a nearly 80% decline from its 2025 highs, and over the last 52 weeks alone, it's down over 61%.
Yeah, so our mission today is to take a strictly impartial look at the data driving that chart.
Right, and just to be clear, we are not here to tell you to buy or sell.
No, not at all. We are here to reverse engineer this turnaround thesis and answer one core question.
Which is, if Fiserv is truly a dying legacy tech dinosaur, why are company insiders and these major activist investors suddenly risking hundreds of millions of dollars on it?
It's a great question. And to understand the activists, I think we have to start by validating the fear in the broader market.
The fundamentals.
Right. The stock is currently trading right around $53.94.
Which is drastically closer to its 52-week low of $47 than its high.
The high was what, like $141?
Yeah, $141 and change. And year to date, it's hovering near a negative 20% return.
And the catalyst for that sell-off seems completely obvious when you look at the top-line deceleration.
Yeah, trailing 12-month revenue growth is sitting at a really sluggish 1.87%.
And Q2 earnings are actually projected to decline.
Which, in the fintech sector, sub 2% growth is practically moving backwards.
Exactly. Wall Street trades so heavily on top-line momentum in technology. When that growth stalls, the algorithms and the, institutional analysts tend to assume the absolute worst.
They assume the company's competitive moat has just evaporated.
Right. Or that agile startups are cannibalizing their market share. The immediate reflex is to hit the sell button before the multiple compresses any further.
But, and this is where I got stuck, I'm looking at this PE ratio, and it is sitting at just 8.98.
It's sub 9.
Yeah. In the tech space, a multiple that low usually screams value trap, not discount.
It really makes you wonder if the broader market believes the underlying engine is actually dead.
Because investors usually pay a huge premium for fintech, right? PE ratios of 20, 30, or even higher because they are pricing in future expansion.
Right. So a sub-9 PE suggests the market is pricing in terminal decline.
They're basically pricing it for bankruptcy.
And it is incredibly easy to assume it's a value trap if you just stop your analysis at that sluggish top-line revenue growth.
But you can't stop there.
No, because the counterargument, and really the reason this whole thesis is so compelling, is buried in the margin data.
This blew my mind.
Yeah, despite the lack of top-line expansion, Fiserv is maintaining a gross margin of 58%.
58.06, to be exact.
Right, and a net margin of 15.17%.
Which means they are heavily insulated.
Exactly.
I mean, think about it. If they were a dying company desperately trying to hold on to market share, you would expect to see them slashing prices.
Right, or spending incredibly heavily on marketing just to keep customers.
Right, which would absolutely crush their margins.
But that isn't happening. That is the crucial distinction here. A 15% net margin on a company with a $28.7 billion market cap.
It proves they possess tremendous pricing power.
And operational leverage. They aren't burning cash to keep the lights on. They are a highly efficient cash generation machine.
So the revenue growth has slowed.
Yeah.
But the profitability of the existing revenue is basically pristine.
Pristine, yeah. And the market is entirely ignoring that cash generation.
Which brings us to the price-to-book ratio.
This is wild.
It is sitting at 1.09.
Okay, so trading at a 1.09 price to book basically means the market is valuing Fiserv's future potential, its brand equity, its entire software ecosystem.
At zero.
At zero. You are buying the financial plumbing at its literal carrying cost.
It's the equivalent of buying a fully operational, highly profitable factory, but you are only paying for the scrap value of the steel and the bricks.
Right. The market has become so fixated on the lack of immediate revenue growth that it has completely disconnected the stock price from the intrinsic value of the actual assets on the balance sheet.
Okay, so if the market is practically giving away the software ecosystem, what are you actually buying when you acquire that plumbing?
This is where we get into the catalysts.
Yeah, because the true crown jewels of Fiserv aren't necessarily its generic processing software.
No, the real treasure lies in its ownership of two massive debit networks.
Star and Excel.
Yes. Those two networks represent one of the widest economic moats in modern finance.
They don't just process transactions, do they?
No, they are the fundamental routing infrastructure. They literally connect the merchant point-of-sale terminals to the consumer's bank account.
But wait, let me play devil's advocate for you. If tearing out that IT infrastructure is so hard, wouldn't the biggest banks just try to build their own proprietary debit networks?
You'd think so, right?
I mean, they have virtually infinite capital. Why do they even need Star or Excel?
Well, the thing is, capital isn't the barrier to entry here. The network effect is the barrier.
Oh, interesting.
Yeah, you could spend $10 billion building the most advanced routing protocol in the world, but if millions of merchants don't have the hardware or software to accept it,
Right.
and thousands of regional banks aren't integrated into the clearing process, your shiny new network is completely useless.
So Star and Excel already have that omnipresent integration.
Exactly. The switching costs for a bank to move away from them are astronomical. It involves massive IT overhauls, vendor lock-in, and, frankly, the terrifying risk of transaction outages.
But it wants the system to go down on Black Friday.
Exactly.
Which perfectly explains the massive rumor that is dominating this whole discussion right now.
The consortium rumor.
Yes, a consortium of megabanks, and we're talking JP Morgan Chase, Bank of America, Wells Fargo, and PNC.
The heavy hitters.
Right. They have reportedly engaged in tentative discussions to acquire these Star and Excel networks directly from Fiserv.
And if we connect this to the bigger picture, this bank consortium rumor completely validates the sum of the parts valuation strategy.
Also,
While traditional equity analysts might be deeply frustrated with Fiserv as a holistic corporate entity because of that 1.8% revenue growth.
sure.
But JP Morgan and Bank of America couldn't care less about Fiserv's top-line growth. They care about the utility of those routing pipes.
It's like buying a struggling, poorly managed restaurant. Not because you want to sell their mediocre food,
Right.
but because the restaurant happens to sit on a piece of prime real estate in downtown Manhattan.
That is a perfect analogy. The business operations might be lagging, but the underlying dirt is worth 50 times what the business generates in a year.
And the market is currently pricing Fiserv based on the cold French fries, while the banks are eyeing the billion-dollar real estate.
Exactly. And those banks recognize that acquiring the infrastructure outright gives them ultimate control over the transaction economics.
Rather than paying routing fees to a third-party vendor like Fiserv in perpetuity.
Right, they can just own the toll road themselves.
Wow. Okay, so we've established that the internal engine is highly profitable.
Yeah.
The carrying assets are being valued at scrap metal prices.
Right?
And the biggest financial institutions on the planet want to buy the pipes.
Check.
So the obvious question becomes, who is stepping in to force Wall Street to wake up and recognize this sum of the parts value?
Let's talk about sentiment and technicals.
Yeah.
Because we are witnessing a textbook divergence in sentiment based on time horizons right now.
Yeah, the broader analyst community is operating on a very short-term defensive footing.
Right, like Truist Securities recently downgraded their price target on Fiserv to $52.
They maintained a cautious hold rating. And I can actually understand the analyst perspective there.
Oh, for sure.
If your entire job is to predict what the stock will do over the next 3 to 6 months, and you are staring down the barrel of a projected Q2 earnings decline.
You have to issue a downgrade to protect your clients.
Exactly.
Yeah.
You can't recommend a stock based on a hypothetical bank buyout that might take 2 years to clear regulatory hurdles.
But that short-term bias creates the inefficiency that activist investors prey upon.
Enter JANA Partners.
Yes. Analysts are paralyzed by the next earnings call, but JANA Partners is looking at the intrinsic asset value.
And they recently disclosed a massive stake. $247.5 million.
That's 4.4 million shares.
Making Fiserv their third largest holding. And for you listening, if you track this space, JANA Partners is not known for taking passive, quiet stakes.
No, they are not.
When an activist fund drops $250 million into a distressed stock, they aren't hoping for organic growth.
No, they are aggressively pushing the Fiserv board to conduct a strategic portfolio review and execute massive divestitures.
They essentially want to force the board to sell that Manhattan real estate we talked about.
Right. Unlock the cash from those debit networks and return it to the shareholders.
Because activists operate by applying leverage. They don't just send polite letters.
No, they threaten proxy fights, they rally institutional voting blocks, they demand board seats if management refuses to pivot.
JANA's thesis is basically that the market will never assign a fair multiple to Fiserv as long as it's a bloated conglomerate.
The only way to realize the value is to break it apart.
But while the activist pressure is compelling, there is a data point in this analysis that genuinely stopped me in my tracks.
The insider buying.
Yes. Over the last 90 days, the insiders at Fiserv, so we're talking the executives, the board members, the people with intimate access to the actual health of the company,
Right.
They have executed 27 individual buy transactions totaling over 236,000 shares.
And you know what the number of insider sell transactions was over that same 90-day window?
0.
0. The insider sentiment score provided in the data is a flawless 100.
That is a staggering statistical anomaly. I mean, executives usually sell stock all the time for completely benign reasons.
Tax obligations, diversifying their portfolios.
Buying a boat, buying a house, whatever.
Yeah.
But when you see 27 buys and 0 sells, it means the people running the business believe the upside is so asymmetrical that they're willing to lock up their own liquidity to ride it out.
And what's fascinating here is how this technical data perfectly aligns with the activist thesis. We are seeing something called selling exhaustion in the chart.
Selling exhaustion.
Yeah. During the recent price drops, the trading volume has been incredibly low. It's operating at roughly 0.8 times its normal volume regime.
Meaning the weak hands have already folded.
Exactly. The institutional money managers who dump stock at the first sign of a slowing top line, they've already exited their positions.
Leaving only the high conviction buyers.
Right. A drop on low volume suggests the downward momentum is running out of fuel. The people who wanted to panic sell are gone.
So you combine that selling exhaustion with a massive influx of insider buying and this activist capital, and you have the structural foundation for a major price reversal.
It sounds like a bulletproof setup.
It really does.
Yeah.
You have the depressed valuation, the highly profitable core engine, the activist pressure, and undeniable insider confidence. But investing is never that clean.
No, it's not.
So I want to push back on this perfect turnaround narrative and look at the bear case.
Let's do it.
Why was Truist Securities so confident in cutting their price target to $52? There has to be a glaring execution risk here.
The execution risk is monumental. And it centers entirely on the chaos currently unfolding in the C-suite.
The management turnover.
Right, because pulling off a strategic divestiture of multi-billion-dollar assets, especially when you are negotiating with the ruthless M&A teams at JP Morgan and Bank of America,
Need a shark.
you require a hyper-competent, unified management team. And Fiserv currently has the exact opposite.
The turnover is bordering on absurd right now. Takis Georgakopoulos just took over as CEO in June.
Right, and he replaced Mike Lyons, who didn't even manage to survive a full year in the position.
Less than a year.
Yeah.
And it gets worse. Just weeks after the new CEO arrived, the president of the company, Divya Suryadevara, headed for the exits in early July.
This raises such an important question. How can a board of directors effectively negotiate a complex, industry-altering asset sale when their executive leadership is a revolving door?
But can't. Institutional investors despise uncertainty.
Exactly. And a new CEO who is still figuring out where the bathrooms are is hardly in a position to defend a $10 billion valuation against a consortium of megabanks.
That isn't just a red flag. That is a five-alarm fire for any traditional investor.
Oh, absolutely.
I mean, if you are looking at Fiserv today, you are essentially making a highly specific, leveraged bet.
What's the bet?
You are betting that JANA Partners has the muscle to overpower this fractured board, bypass the chaotic C-suite, and force the asset sale themselves.
Right. You are investing in the activist's playbook, not in the current management's ability to execute an organic turnaround. And that really is the crux of the thesis, because JANA Partners isn't blind to the governance chaos.
No, they're not.
They are actively citing it in their communications. They view the C-suite instability as the primary reason the stock is mispriced in the first place.
So the activist's goal is to step into that leadership vacuum, stabilize the strategic direction, and force the divestiture before the core business deteriorates further. Okay, so what does this all mean for the final verdict? Let's bring all these threads together.
The analysis synthesizes all of these factors, the deep discount, the internal profitability, the activist catalysts, and it assigns Fiserv a bullish score of 7.
A bullish 7.
Mm-hmm.
But we should note, it explicitly frames the stock as a medium-term hold.
Right, strictly looking out over a 6 to 12-month horizon.
And that timeline makes total sense, given what we've discussed today. I mean, you can't untangle a C-suite mess and negotiate a multi-billion-dollar infrastructure sale over a weekend.
No, it takes months for an activist to build a coalition, file the necessary proxy paperwork, and actually force a strategic review.
And it takes even longer to clear the inevitable regulatory hurdles that come with selling financial plumbing to a bank consortium.
It is a deliberate, methodical process. Anyone looking at this play has to possess the patience to wait out the short-term earnings turbulence while JANA operates behind the scenes.
And as always, we want to remind you that analyzing a turnaround thesis is about understanding the mechanics of risk and reward. It's not about blindly following the smart money.
Never.
A thesis can look structurally perfect, but if the board successfully stonewalls the activist, or if the megabanks walk away from the negotiation table,
that 6 to 12-month timeline can quickly turn into dead money.
Exactly. Our goal today is to give you the framework to view the raw data through multiple lenses.
Yeah.
You have to balance the immediate fear of top-line stagnation against the long-term, sum-of-the-parts reality of the balance sheet.
It fundamentally comes down to recognizing when a company's market price has decoupled from the intrinsic value of its assets.
Right.
And understanding the catalysts required to force those two numbers back into alignment.
It's fascinating. And as we wrap up this discussion, I want to leave you with a broader systemic thought that isn't directly addressed in the financial data, but is so crucial for the wider economy.
Okay, let's hear it.
We discussed the massive competitive advantage of Star and Excel, right? How deeply embedded they are in our financial plumbing.
Yeah, they are everywhere.
If this consortium of megabanks, JP Morgan, Bank of America, Wells Fargo, actually succeeds in buying those independent debit networks, does that consolidate too much power at the top of the financial food chain?
Oh, wow. That's a great point.
Because what happens to the thousands of smaller regional banks and credit unions when the biggest players in the industry don't just use the infrastructure, but actually own the toll booths?
It introduces a profound systemic risk. I mean, when the largest competitors on the field are allowed to purchase the stadium, they inevitably start changing the rules of the game to favor themselves.
Something to think deeply about the next time you swipe your debit card.
For sure.
Well, just a reminder to check out that special 14-day trial link for Stock Oracle below in the description.
Yep, it is an AI-aided stock research platform to help you look into data just like this.
And again, it's an affiliate link, so we might earn a commission at no extra cost to you. But remember, it is not financial advice or a trading signal service, and the AI insights can be incomplete or wrong.
Always do your own digging and verify the facts.
Exactly. And if you found this helpful, please consider subscribe, like, and comment underneath. We'll catch you next time.